This is the tricky part is we came into this year with extraordinary expectations, and really that framed the case for a more cautious view at the start of the year, which has only been amplified by now serious downside risk that results in the economy and the earnings outlook as a result of tariff implementations. The only place, in the equity market when you're in these periods of panic and in these periods of distress, you really want to focus on beta. What we find is lower beta sectors like consumer staples and utilities tend to perform relatively well, at least sheltering you from a tremendous amount of downside portfolio risk. Likewise, when you look across the world, the U.S. market at large is actually one of the highest beta markets right now. That's why we're seeing the U.S. sell off as much as it is, whereas other markets like Saudi Arabia, relatively stable. Brazil, up until Friday, had been a relatively stable market because it's very low beta. So beta tends to drive a lot of trends. We'll get to the point where we start thinking about recession risks. I think we've started to turn that corner already, and you'll see analyst revision momentum shift viciously negative. It already was negative because, again, expectations were too high. But analysts are just now starting to think about how tariffs really impact their numbers going into the second half of this year, because it was always an unknown until just last week.
Yeah, but even still, like if I'm a company and I got a report on Friday and I'm JP Morgan, like how do I possibly know what kind of outlook or forecast can I give? And that's just for any company, honestly.
I think if you want to be offer full disclosure, you present scenarios. Frankly,
it's like a fan chart for earnings.
Yeah, it's sort of in the end, we need to consider what would happen if these tariffs are indeed implemented and a trade war breaks out, which does appear to be what's happening right now. It's very difficult because they're reporting on earnings that happened before last week. So they're reporting on the first quarter, which was really just riddled with a lot of uncertainty, but not a tremendous amount of implemented tariffs. Now they've got to consider in the second quarter, we will likely have implementation of these new tariff rates. If they are implemented, what does that mean for your outlook is a huge question mark, but we really should be considering now what it might mean for the outlook. And that's going to be mostly in the commentary, not in the results themselves.
Right.
Gina, Tom from the Upper East Side writes in and asks, what does a VIX of 52 mean to you?
Extreme volatility has emerged in the equity market. Fear has definitely started to emerge. We very rarely see a VIX like this without sort of severe market weakness. So it's really consistent with what you're experiencing in price. Is fear has now emerged. Panic is running the show. Panic means we're going to have very volatile days as a consequence of where markets are. So it's really just consistent, frankly, with the price trading. It's very rare to see this kind of VIX without some kind of near-term bottom formation, except for in periods like the Great Financial Crisis or the tech bubble crashing. So your risk now is maybe this is just the beginning. And I think that a lot of people are just coming around to that notion. Normally, people are buying a VIX spike that is this high. But if we're going to see significant fundamental deterioration and longer-term disruptions like the 2000 to 2002 period or the 2008 to 2009 period, this may be just the first of many.